This is your LMAX exchange technical update for Monday, August 14th, 2017. Euro dollar. So the euro has rallied back up a bit since trading down towards 116.90, but overall weekly studies still show this market quite extended in an overbought territory with room to correct further before we see a meaningful bullish resumption. Now we could see a trade back up towards that recent high at 119.11 over the coming sessions, but if we do poke above 119.11, any additional gain should be limited to the 120 area in favor of additional declines to allow for these studies to unwind from overbought. This could set up over the coming sessions the possibility for a double top formation, and if we break back down below 116.90, it would open the door for a move back down towards 115. The initial support for this market comes in by the 50-day moving average, which is in the 114 area. So it would coincide with this 115 level if the market does break down below 116.90 towards that 50-day moving average, which would also be a objective off a potential double top formation following the break below the 1690 neckline. Again, there is risk over the coming sessions that we go back towards the 2017 high and maybe even poke above, but with technical studies on the weekly still quite extended, additional upside should be limited in favor of more meaningful corrective decline. Sterling dollar. So cable has been chopping around since trading up to a fresh 2017 high, and we could see more chop with the possibility even for setbacks to extend back down towards that previous major range high at 127.75 from earlier this year before the market considers pushing up for that next big upside extension towards 135. Overall, the structure is constructive now following the breakout above 27.75 earlier this year, but again, there is risk for some more choppy consolidation and potentially setbacks towards that previous resistance now turn support before the market looks to head significantly higher. Dollar yen. Dollar yen is traded down towards some critical support in the form of the 2017 low, just shy of 108. There is risk over the coming sessions that the market continues lower and tests that level. And if we do see now a breakdown, a clear breakdown below that 2017 low around 108, it could open the door for a more pronounced decline that takes this market now down towards 102. That may sound a little bit crazy at this point, but again, if the market establishes below 108 following a consolidation roughly between 108 and 114, 102 doesn't sound too crazy at that point. But we are trading still within this range over the past several weeks, roughly between the 114 area and 108, and so the market could just as easily find some support down here ahead of a bounce all the way back towards that resistance up in the 114 to 115 area. Euro Swiss. So Euro Swiss has come off its recent 2017 high, which is also the highest levels that we'd seen since January 2015 when we saw that memorable collapse in Euro Swiss. The market has pulled back from the 115.39 high all the way back down into the 112s, but there is still risk that we trade back down into this previous resistance zone now turned support in the 110 to 112 area before the market considers any meaningful bullish resumption beyond 115.39 and back towards 120 in the weeks and months ahead. Aussie dollar. So Aussie has been showing some form of a top off its 2017 and plus 2-year high above 80, and although we did see a bit of a bounce in Friday trade, there is risk that any additional upside here should be limited in favor of a lower top and continuation of these setbacks, potentially back down towards the 76 to 77 area before the market considers its next big move. Dollar CAD. So dollar CAD has been in the process of correcting out from its recent plus 2-year low that was established just several days back at 124.14, and although we did see a bearish reversal day in Friday trade, we could see these setbacks be well supported now in favor of a higher low and continuation of this correction back towards a key 38.2 fib retracement off of the 2017 high to low move, which comes in at 129.40. Of course, that also is just shy of that psychological barrier at 130, which also acts as a previous support now turned resistance zone. Kiwi dollar. So the New Zealand dollar has been in the process of a nice correction off its recent plus 2-year high above 75, and there is room now for these setbacks to extend some more back towards some key support for this market around 72. If we see any rallies in the sessions ahead, don't expect the market to put in a meaningful bullish resumption, and instead it could see a lower top ahead of that next drop down towards the 72 handle. SPX 500. So a notable pullback in the S&P 500 in the previous week, with the market finally taking out some key short-term support around 24.58. And this sets the stage, or at least it eliminates the immediate topside pressure, or alleviates immediate topside pressure, setting the stage for a potential bearish structural shift. Of course, to see that play out, the market would need to establish below 2400. So right now, the breakdown is just a minor correction within a very well-defined, intense uptrend over the past several years that has taken us to record highs. But at the same time, if the market establishes back below 2400, then we could be seeing a more significant bearish structural shift in this market. Gold. So gold has exploded to the top side over the past few sessions, with the market now trading up just shy of the 2017 high at 1296. There is risk now for the market to extend above this area and through 1300, taking it up towards a retest of the 2016 critical peak at 1375. Any setbacks in this market should be very well supported, as they have been over the past several months, with only a break back below 1200 to compromise the constructive outlook for gold.